Okay. Good morning, everyone, and thank you for joining us today. The title of today's session, Solitaire Building Conviction in Uncertain Times, reflects what many of us as investors are experiencing right now. Markets are volatile, sentiment is uncertain. So, this session is not about predicting the next market move or chasing the flavor of the season, right? It's about showing you how Solitaire has stayed. Anchored to its core investment philosophy, right? Even as the environment around us has been shifting constantly. So we will walk you through how Solitaire has remained disciplined by continuing to back fundamentally strong and high quality businesses, and how we have build and hold on to conviction, not by following noise or momentum, but by understanding the business models and giving them time to play out, right? So we will also share data and examples and some portfolio related strategies that we have adopted. But more importantly, you will see why patience, consistency, and staying true to process matters more than ever in uncertain times or markets like what we are seeing presently. So let's get started. We'll move to the first slide. Right. So the core investment philosophy of Solitaire, right? I'll just quickly walk you through that, right? There are 4 pillars on your screen, and they're not just words. They define how we build conviction in the portfolio, especially when the sentiment or the environment gets uncertain, right? The first is long-term focus. We are not chasing quarterly performance or market noise. Our goal is to identify fundamentally strong businesses and hold them long enough for the full value to emerge. Real wealth creation takes time, and we build portfolios with that mindset only, right? Second is non-consensus investing. We don't invest where the crowd is going. In fact, many of our best performing stocks started out as ideas the market didn't care about, right? We look for businesses that are undervalued, overlooked, or are out of favor, right? But that's where the best opportunities are often found. Third is bottom-up approach. So we don't invest based on headlines or sectors. We go deep into individual companies, studying their governance, management quality, balance sheet strength, and return ratios and various other metrics. We generally like companies with low leverage, high return on capital, stable cash flows, and we are happy to wait if the price isn't right. But we'll stick to our bottom-up approach. And finally, there's a strong focus on risk management. We don't believe in overloading the portfolio just to chase returns. Position sizing, diversification, and disciplined capital deployment are all part of how we manage downside risk. We would rather underperform for a while than take undue risk that we will regret later. So this philosophy of long-term thinking, independent idea generation, bottom-up stock picking, and disciplined risk control, right, is what gives Solitaire its strength and stability. And especially during market volatility, this is what allows us to stay grounded and focused. But beyond this 4-5 points which I discussed now, there's something even more important, and that's adaptability. We don't believe investment success comes from following a rigid formula. I think it comes from evolving with market cycles, with changing business realities, and with investor needs, right? So at Solitaire, we have built not just a portfolio, but more of a framework that supports you through the journey, encouraging participation during drawdowns, guiding capital deployment at the right moments, and helping you stay in when markets are testing your patience. Because investing is not just about numbers, right? It's also about behavior, about confidence, discipline, conviction, right? And that's why everything we do, from our research to our communication, is built around to help you stay committed to a process that is thoughtful, tested, and aligned to your long-term financial goals, right? So, moving on, right? So, since you've seen the foundation and the four important pillars, right, on how we think, right, let me quickly take you through what truly makes this portfolio, Solitaire portfolio, different in practice, right? The first is customized portfolios, right? We don't follow a model portfolio for all investors. Solitaire takes a different route, right? I think we build portfolios gradually and thoughtfully, and over time, they evolve uniquely for each client. Your portfolio is shaped not just by our investment calls, but by your level of participation, how you respond to opportunities, how consistently you deploy capital, and whether you are adding during key drawdowns. That's how the portfolio is getting differentiated and customized. Two investors may start at the same time with the same capital, right? But if one adds during market dips, right, the long term outcome can be very different. And this partnership mindset, where investor behavior also influences results, is what sets Solitaire apart. We are trying to build wealth creation journeys with our clients. Second, we focus on positioning portfolios for structural long-term trends, right? We are always looking for companies that are aligned with long-term structural trends, but we never chase stories blindly, right? Every business still has to pass through our core filters: strong governance, clean balance sheets, capital efficiency, and fair valuations, right? Just because a business is in a trending space doesn't mean it's right for your portfolio. It must also be fundamentally a strong business, because that's what holds up in the long run. Thirdly, we believe in opportunistic buying. We wait for the right moments, times when the market is under pressure or where good companies are being ignored. That's when we step in. This approach needs patience, experience, confidence, and it's helped us accumulate some of our best positions over the years. We are always telling our investors the capital you add during the tough times often becomes the strongest compounding engine in your portfolio. That's why we stay alert and encourage top ups during volatility. And finally, we follow a low churn buy and hold strategy. Once we have built conviction in a business, we give it time to deliver. We are not in and out of names just to chase returns. We let the business compound and the thesis play out, right? This reduces transaction costs, builds portfolio stability, and most importantly, helps us avoid common behavioral traps like switching too often or reacting to short term noise and acting impatiently, right? So, in summary, building customized portfolios, which gets differentiated over a period of time, future ready businesses, disciplined and opportunistic buying, and a long term low churn approach. I think that's what is defining the Solitaire strategy. And this is not just philosophy, it's also reflecting in our portfolios. Every decision we take is driven by these principles, and the whole portfolio construct happens around this philosophy, right? And that's how we aim to create consistent risk adjusted returns over time, even in uncertain markets like what we have been seeing over the past few months. Yeah, thanks. So the point on low churn, right? So this chart shows the equity position in Solitaire from the time we launched. So one thing is very clear from this chart, right? That we stay invested. Our equity allocation has consistently remained in the 85 to 95, 97% range, and cash calls are rare. We stay invested because in businesses we believe in, and when the opportunity allows, we even add selectively. But it's important to understand how we arrive at this. So we don't invest everything on day one, right? At Solitaire, we build portfolios gradually in tranches and with a lot of intent, right? We wait for the right businesses, the right valuations, and the right conditions. And as those align, we construct positions step by step. So what this does is it allows us to enter quality names at favorable prices, and not all at once, but over a period of time, right? And once the portfolio is built, our preference is to stay invested. We are not constantly reshuffling or making tactical cash moves. Uh, our approach is based on conviction, not fear or timing. So what we are trying to do, we are trying to let our businesses compound by staying disciplined and by following a long-term thesis that we feel is going to play out over a 4 to 5 year period. So that's what you're seeing here. This steady equity line is a reflection of our process. We build and deploy with purpose, and we stay invested through cycles by being patient in entry, disciplined in holding, and with long-term focused outcomes, right? But one drop you are seeing in from August to October, December is when around that time the valuations were slightly expensive, some of the businesses we own, and the portfolio was transitioning. That's what you're seeing, that drop, and then again pick up in the equity allocation, because some businesses were being sold and new businesses were being bought, which were available at uh, much more reasonable valuations, right? So that's the dip that you're seeing there. So moving on. So what yeah, you can go to the next slide. Yeah. So here, what exactly makes a great investment? So at Solitaire, we believe that great investments happen when strong fundamentals meet attractive valuations. It sounds simple, but applying this consistently takes discipline, patience, and clarity. So let's see first on the fundamentals part, right? Uh, a business might be in the right sector or trend, but if it's not fundamentally sound, we are not interested, right? Because in the long run, no amount of optimism or narrative can protect you from weak numbers, right? So, strong fundamentals, what does it mean to us, right? So, we are looking for a good corporate governance, companies where management respects shareholders, acts transparently, and are making responsible decisions. Uh, we focus on leadership quality, experienced promoters and teams who have demonstrated the ability to and allocate capital well and deliver through different market cycles. Right? We are looking for industry leaders, businesses that are number one or two or three in their space, right? And they, because they typically enjoy pricing power, uh, better margins, and they have certain competitive advantages, right? We are also looking at high ROC because efficient capital use is a sign of a healthy business model. And finally, we prefer companies with low or zero debt. In difficult market conditions, debt can be a major risk. And debt free businesses, on the other end, offer resilience and protect the downside, right? So, these are some of the fundamentals that we are looking for while buying into any business. But fundamentals alone are not enough. They are not enough. Even the best businesses can be a poor investment if you enter at the wrong price, right? So, which brings us to the second half of the equation, the attractive valuations, right? So, we are not chasing stocks that are expensive or in the news. We wait, we track businesses for months, sometimes even for few years, and wait for that window. Maybe a market correction, a temporary dip, or an event driven mispricing, right, to enter at the right valuation. And this is where we believe real value can be created, not just by identifying good businesses, but by entering them at prices that offer margin of safety and also upside potential, right? And this is also where investor participation matters a lot. When we call for capital during a correction, it's often because we are seeing quality businesses at fair or discounted valuations, right? Investors who respond in those moments tend to hold these companies at much better prices, which compounds meaningfully over time, right? So when both this come together, right, strong fundamentals and reasonable valuations, so that's our sweet spot. And we act when both come together, and we try to build positions around that time. And that is what has helped us stay calm during volatile phases. Because when you know you own fundamentally sound businesses bought at the right price, you don't have anything to panic for, right? You don't have to react to noise. You just need to stay invested, stay patient, and let the business do its job, right? So, to sum up, great investments aren't about chasing trends or quick returns. They come from doing the hard work, studying businesses, waiting for the right entry, by being patient, and having the conviction to act when it matters the most, right? And that's what we are trying to do at Solitaire, so that you, as an investor, can enjoy a low stress and a high conviction investment journey, right? So, with this, I'll just ask Senthil to come in and take us through some of the portfolio related quants, which will show you the points that I have been speaking about.
Thanks, Gaurav, and good morning to everyone. So, as Gaurav has walked you through the entire philosophy of the Solitaire, so we will look at in two sections, the investment process, and then what's the outcome, so metrics of this philosophy, and then the investment process. Uh, so starting with the investment process, so as all of you know, we in Indian equity market, we have close to around 5,000 odd companies which are listed. So among this 5,000 odd companies, there are only a handful of companies which can be qualified for a solitaire kind of strategy. So that involves filtering across like the entire management track record over the years, and then how they have treated the minority shareholders, and then the business model, and then the entire financial analysis and the valuation comes into the picture. So with this, if you see if you take any sector, right, there will be around only on 10 to 12 companies which qualifies for the basic hygiene check of balance sheet and then management. So within these 10, 12 companies, we again we have to filter it out. And then finally, we arrived only at one or two companies which has a unique business model, either in terms of technology or in terms of product, which makes the company stand out globally. So if you see in Solitaire, we will see like we have a good allocation of companies which are globally competitive in nature, not only in India. So in that way, Solitaire generally focus on companies within the sector which can stand out domestically and globally. So that's how the companies are chosen from the entire universe, and then uh, directly, if you see the once the shortlisted companies, it goes to the pipeline. So we have a list of pipeline stocks. So if the valuations are not favorable, or we need some more time to get to understand the management, the stock immediately doesn't go into the portfolio. It's in the pipeline. So even in the pipeline, it's actively worked upon. So once the conviction is there for the analyst, for the fund manager, then obviously at a right time, the stock gets into the portfolio. Uh, So we have seen the first part, right? The generation. So most of the investors' view is about or focus is on ideas and idea generation. But in Solitaire, we equally give importance to execution and maintenance. Because where execution plays a key role is that in terms of, for example, allocation to a particular stock. Uh, so the allocation should happen at a optimum price and also without distorting the existing price. And so if you have a upper limit of 3%, I think the 3% should be executed at a precise price. That's where across all the investors. So that's where the execution plays a key role in moving from generation to execution. And once the idea is executed and it's in the portfolio, even more important role is from the maintenance side. Because as you know, being the last few years, we have seen right from COVID to a lot of inflationary times we went through, and then now we are seeing across the world, the trade tariffs is uh, playing a lot of creating a lot of issues for the businesses. So existing portfolio companies are rigorously tracked so that you're top of their business, and then our conviction continues to stay over there. So that's broadly in terms of how the idea, how we generate and how we execute, and then how we maintain the ideas. So the next section we will focus on what's the outcome of the first two parts in terms of the philosophy and then the ideas. Uh, with both of these things, I think we will look at the current outcome. Uh, so if you see currently we have close to around 39 stocks in the portfolio. And out of these 39 stocks, if you see, almost 90% of the businesses that we own are either number one or number two in their business. So effectively, we are owning companies which are market leaders in their business, both in domestic and in global. So why it makes important is that particularly during the current uncertainty in terms of macro issues is that uh, so we have seen that during these uncertain macro times, market leaders they have the ability to withstand these macro issues and then stabilize their business, and then with a strong balance sheet they will be able to find some inorganic opportunities, because usually during this tough times we have seen that smaller players will be facing a lot of issues, both from the P&L side and also mostly from the balance sheet side with respect to the working capital and things like that. Uh, so having positioned our portfolio towards market leaders, uh, during uncertain macro, we will get additional opportunities in terms of acquisition for these companies. So that also eventually helps and providing additional growth to these companies. Next, if you look at the like I had mentioned in the last slide, balance sheet. So if you see in Solitaire versus the benchmark, BSE 500 is our benchmark. So percentage of companies with debt is just 23% in Solitaire. So this is just an outcome of the entire investment process and the philosophy. Uh, we just don't look for low debt or low leverage companies, but by just focusing on companies which are market leaders and which has a good business model, eventually the balance sheet is very strong for this set of companies. Yeah. Uh, So the next important data with respect to portfolio is that in terms of market cap classification. So here you can see that we have a large and mid cap allocation is close to around 42%, and the small cap is around 54%. So here I will just explain a bit more in terms of a small cap allocation. So what happens here is that uh, so the market cap classification is provided by AMFI on a 6 monthly basis. So if you see as of last announcement in December 24, any stock with a market cap less than 32,000 crores is classified as a small cap. So if you see a company with a 30,000 crores market cap is also a small cap. A company with a 30 crores or 300 crores is also classified as a small cap. So we having 54% allocation to small cap doesn't means that we have fair large bit of allocation towards companies which are more than 2,000 crores in market cap. Uh, so just this is because of the classification from the regulator. Those stocks are classified as small cap. So that's we want to just explain a bit more on that. And uh, if you see around 18 to 20% of our weightage is towards MNC companies. Traditionally, we see MNC companies, they are very much uh, clear in terms of strategy, execution, and clear management succession planning. And then they also have a stable, strong balance sheets. And then usually these companies are very large free cash flow generating companies. And they, what are the capex is involved, they'll be able to just internally uh, uh, source the capital for the future growth capex needs. So that's where the MNCs also have a good and fair bit of allocation in the portfolio. So overall, with this allocation and um, uh, portfolio structure, so the beta of the portfolio is just 0.76. So that's where the this is just the end result of the philosophy and the strategy. So just want to highlight that also. In terms of moving forward to the sector level allocation, here you can see that uh, we have a diversified sector level allocation, and this sector level allocation has also transitioned over the years. So if someone has been with us for the last 5 years, he might have noticed that depending upon the macro side, how the fundamentals are playing out, how the government is being, where the government is looking to put more cash. So depending upon all these things, the sector level allocations also change quite a bit, and so that's where we are. And if you see our top four sectors currently are consumption, followed by financial services, and then we have capital goods and automobiles. So these are currently the top four sectors. Moving forward to the allocation side. So again, so this is where our risk management comes into picture. If we see almost 29 stocks out of 39 are has a weight of around 3%. Uh, so it shows that we are not heavily over-reliant on a particular stock or a particular sector to generate returns. So our focus is both on risk and return. And if you see the remaining 10 stocks which are in the 3 to 5% bucket, and just one stock in the above 5%, these stocks are themselves are qualified to be having a higher weightage. So in terms of our conviction in their business, and we would have invested at a lower weight, and obviously because of their performance, they would have gone up in terms of their allocation. Uh, so we have seen a lot of slides with respect to how Solitaire has been constructed so far. And the next slide is how Solitaire stands out versus the other existing flexi cap mutual funds. And again, if we see, uh, so this data, what it portrays is that Solitaire portfolio versus the mutual fund, these flexi cap portfolios, how much is Solitaire away from these mutual funds? So here you can see that on an average, Solitaire is like around 75 to 80% owning stocks which are away from these flexi cap mutual funds. Uh, so that's where what Gaurav was highlighting in terms of our contrarian bet, in terms of looking to buy stocks at opportunity time at a reasonable valuation comes into the picture. So having seen all these Solitaire quants, just I would like to share one of the how we went about this particular to with respect to this stock. So here you can see in terms of different time periods. Uh, so the initial buying happened at a time when the valuations were reasonable and the business is also, we felt that it is getting into a zone where the growth can improve much further. So both from the growth perspective and over the next 3-5 years, it's not like a next 1 year the company will perform well. So what generally we look forward is that growth at least over the next 3 years, the company should be able to perform better and with reasonable valuations. And the initial buying happened over here, and then so that technically I think the stock was weak. So you see, we stock was corrected initial buying, and then we were accumulating the stock. And post that, you see, so what happens is that as the business started to execute, generally we see a lot of interest and from the market participants, and then uh, the stock price went up over the next year and a half, 2 years period. And so, as Gaurav mentioned earlier, we are very much conscious on the valuation. If we don't see that over the next 2-3 years, the stock can uh, perform better in terms of so the stock can perform better in terms of business growth, but if the valuations have related to a certain size, so the next 3 years returns looks very low, then we take a call in terms of trimming down the position. And generally, so trimming down happens in phases, and then unless if the stock is extremely overvalued. So this is just an example of how the execution happens. So it's not that we buy at a time and then we execute, then we sell it at certain time period. So uh, each and everything is followed by a certain set of already set process. So yeah. So lastly, I would like to end with a couple of usual metrics that the investors usually ask in terms of risk versus return. So as I earlier mentioned, beta is close to around 0.76 versus the if you look at the other category average, I mean the flexi cap mutual fund, it's around 0.9. So we are low in terms of volatility versus the flexi cap mutual funds. Coming to the risk versus returns metrics, either in terms of Sharpe ratio or Trinor ratio, if you see the per excess return that we generate versus the risk is quite higher versus the other comparable flexicap mutual funds. So of course, these are like outcome of the entire investment process, but you could just like to highlight these metrics for the broader interest of the audience. Yeah. So with this, I will just hand over to Gaurav again to walk through to the last part of the presentation.
Thank you, Senthil, for sharing those very important points reflecting our philosophy on the portfolio. Now, let's talk about something that's just as important as stock selection, and that's investor behavior. I touched upon it a little bit in the beginning of my conversation, but I'll just elaborate a little bit again here. So, there's a common belief that successful investing is all about intelligence, research, or timing, right? But in reality, it's your habits and mindset that often play a bigger role in determining outcomes. So the truth is, many intelligent investors underperform, right? And not because of lack of knowledge, but because they let emotions, ego, or impatience get in the way, right? So, what are some of the behavioral habits that can actually help build a solid portfolio? So, first is consistency. The most successful investors we have seen are not necessarily the ones who made the best stock picks. They are the ones who were consistent in their approach. They stayed confident in their choices, remained patient through market cycles, avoided overreacting to short term news or noise. So that consistency is incredibly powerful in compounding wealth over time, right? And next are a few clear winning habits, right? Simple actions regular monthly investments, like make SIP a hack, right? Or build or being able to add capital during downturns can make a huge difference over the long run, and it's a very important habit to adopt, right? So these habits can help you accumulate more units at lower prices and set you up for stronger recovery when the market returns, right? Uh, there are some of the losing habits that we need to guard ourselves against, right? Like trying to time the market, procrastinating on decisions, or reacting emotionally, like whether it's fear during corrections or fear of missing out during rallies, right? So this all can tend to lead to poor outcomes, uh, right? But it's not about being perfect, right? It's about being aware of how we think, how we react, and how can we improve. And at Solitaire, we work with our investors to help build this positive behaviors. We encourage participation during corrections, and we communicate openly about what we are doing and why we are doing, right? Market dynamic uh, uh, are always changing, right? Opportunities are not going to wait around. And understanding the gestation period of investments, right? Knowing when to act and more importantly, when not to act is what is going to help you ride through volatility and build real conviction, right? So, in the end, success in investing is as much psychological as it is financial. We are trying to cultivate consistency by building the right habits and by staying focused on the long term. And I think the results and the returns will just be an outcome, which is going to follow this whole process, right? Yeah. Moving on, I'll just quickly show you in a way that what the portfolio might look like for a few years, right? Investing isn't about chasing quick wins, right? It's about creating something that grows steadily, like planting a tree, as you can see here, right? You water it, nurture it, uh, give it some time, and then one day you will see the results, right? Similarly, in a thoughtfully constructed portfolio like Solitaire, uh, this is what is typically going to happen, right? You will see a few big winners. Uh, these are companies where the full power of compounding unfolds. They may start quietly, but over time, they grow significantly and become meaningful wealth creators. Then you will have multiple steady performance, right? Businesses that consistently execute, they stay resilient through market cycles and gradually create value, right? They may not always grab headlines, but they deliver year after year, right? And yes, there will be a few one that don't work out as expected, right? And that's just the nature of investing. But the important thing here is how we deal with them. If we notice that a company's fundamentals are weakening, right? We act, we exit the position, not out of emotion, but purely based out of our understanding of what is happening in that business and trying to follow that discipline. And with that, we may exit some of the businesses that are not working out as per our expectations, right? So this balance of letting winners run, nurturing the steady compounders, and exiting the weak businesses, right, is what shapes a strong portfolio over time, right? But the key is to stay patient and keep reviewing performance and the process and the outcomes of the business, right? And trust the process, right? Because in investing, it's not about having a perfect score. It's about making sure the overall direction of the portfolio is forward and upward. And I think when that happens consistently, right, I think wealth compounding happens very, very meaningfully, right? Yes, so that is how we are thinking to construct a portfolio. Right. At Solitaire, right, we operate with a moderate risk approach, right in the middle between conservative and aggressive, right? And Senthil also shared some quants showing how the beta of the portfolio is lower. So our focus is on risk-adjusted returns over a sustainable period of time, right? We believe that this is the right zone for long-term wealth creation without taking unnecessary or undue risk. So our return expectation is inflation plus maybe roughly 7-9% over inflation, depending on market conditions, right? Uh, the portfolio typically holds 25 to 30 companies, right? And we cap our exposure to any single stock at 7%. We avoid companies with high debt or weak fundamentals, right? And we usually don't invest in banks, NBFCs, and PSUs, right? Because they carry higher policy related risk, right? So, what makes us different is how we manage risk, right? So, we focus on controllable risk, like choosing companies with good leadership, low leverage, and sound decision making history, right? So we avoid companies which are not in line with our philosophy and filtering criteria, right? We are also aware of uncontrollable risk, like global events, one that is happening now, right? So we try to keep the portfolio resilient and diversified, right? Over time, this is what is going to help the portfolio handle uncertainty better and also position itself to benefit when things turn around, right? So that's in short the essence of our risk strategy, and that is what we are consistently practicing every day in our portfolio construction approach, right? So with this, I will just quickly talk about what the Solitaire positioning is today. We are now in the 6th year of Solitaire, right? And at its core, right, it's always been about delivering strong long-term returns while keeping risk under control. Uh, the way we do that is, as I was saying earlier, is through a bottom-up approach. So we don't invest based on market noise or macro predictions, right? Our focus is more on understanding businesses, how they operate, and whether they can sustain performance over years, right? So, being a pure flexi-cap strategy, Solitaire gives us the freedom to move around between large, mid, and small caps, depending on where we see the best risk reward, right? So our holding period is typically 3 years or longer. And if the business continues to execute well, we are happy to hold it even longer, right? We don't exit just because something hasn't moved yet. We only exit when the original reasons to own that business no longer apply, right? We are building portfolios gradually, piece by piece, right? We don't rush in. We allocate slowly, adjust weights when valuations get rich, and add fresh businesses when we find better opportunities. So that means the portfolio evolves over time, but it remains rooted in quality, right? When the market is going through a correction, for example, right, and while that can make investors uneasy, right? We actually think that is where the real value is created. Some of the best investments are made during phases like this only, right? When sentiment is low, but fundamentals are strong. And we have seen this in the past 5.5 years of Solitaire, right? So let's say if you are coming in during a volatility period or when a downturn is happening in the market cycle, right? Topping up during this phase, right? It can really shape your long-term outcome. So, Solitaire is designed to benefit from India's domestic growth story, right? As Senthil was also saying, the focus is more domestic, right? So, we are not chasing global themes or volatile sectors, right? We are consciously avoiding over-leveraged companies and high-risk pockets like NBFCs and banking as a whole sector, right? So, what this does is this gives the portfolio stability, especially during uncertain times, right? And what is setting us apart is our mindset, right? We don't believe that more risk equal more returns, right? We believe in taking calculated, well-researched positions, right? And we stay cautious when others are excited, and we get active when others are hesitating, right? And this helps us manage risk slightly better and gives you a smoother experience through various market cycles. Right. So you would have seen, whoever have been with us for a long time would have seen when markets are down, right? We are scaling up and we trim when they are overheated. And in the previous chart which I showed, right, that drop in equity allocation happening in August September period last year was purely because of these reasons, right? We felt at some places the valuations were overheated, and that's why we started trimming some positions, right? So what this is, this discipline helps us manage downside risk and position us well for the upside when the cycle turns, right? Uh, but every now and then, whenever we come across a high conviction idea, a business that truly stands out, when something like that happens or comes, we focus our positions. We take positions, and we invite our investors also to participate alongside, right? If they don't have liquidity in the portfolio, we'll ask for them to participate, right? So Solitaire is just not a product, right? It's a thoughtfully managed strategy, right? Backed by research, discipline, and alignment, right? Our goal is to help you stay consistent, avoid unnecessary risk, and participate in India's long-term growth with confidence, right? So keep contributing, keep participating. That's the simple and proven path to long-term wealth. And that's how we are looking at constructing and building on Solitaire going forward, right? So with this, I'll just quickly run you through some of the basics of the portfolio investment. So key terms are like minimum investment is 50 lakhs as per SEBI's guidelines in a PMS product, right? And benchmark is BSE 500 since it's a flexi cap fund. Exit load on the portfolio is 3% in the first year, 2% in the second, and 1% in the third year. And after third year, there is no exit load. Fee is 1.5% per annum, computed on daily weighted average portfolio, but charged on a quarterly basis. And all other expenses are at actuals. There's no variable or performance fees in this. Also, in terms of risk management, we don't cross a single sector 55% of the portfolio in NAV. As Senthil was showing the composition of the sector, right? You would have seen it's very, very diversified, right? And currently, FMCG and insurance businesses hold the highest allocation in terms of sector. And single stock exposure also, we don't cross 25%. But generally, our sweet spot, as we have been discussing in the past, is between 3 to 5%. Almost 27, 28 companies in our portfolio are in that range, right? And it's a long only fund, only investing in equities. So you won't find us buying into commodities or global or something like that. It's purely long only Indian equity fund, right? So next is this is the performance. Since inception, we started in August 2019, and the numbers are as of April closing. This is also reported on the SEBI's website and on our website also. 22.5% since inception, whereas benchmark has done 18.5%. As we were saying, right, we are building portfolio for long term. So at least three to 4 years is what you should give your portfolio to see the performance and compare it with a benchmark or any other flexi cap product, right? All these returns are post fees and expenses. And yeah, cash levels have been around 2.5% in the portfolio, right? Yeah, no problem. We can move to the next one. Yes. So yeah, this is the team behind managing the whole portfolios or the products that are there at the ithought, Solitaire, Trueblue, Riddhi, Spear, and Neo. So many well and capable people are involved on a day-to-day basis in terms of constructing the portfolios and trying to stick to the process and delivering on that process, right? So yeah. So yes, I think that's all from our side. Uh, and if there are any questions, I think you can post it in the chat box, and we'll try to answer them. So there's a question on I am a Solitaire PMS holder, joined 1 year back. What is the expected return in CAGR of my portfolio over the next 3 to 4 years? Also, what is the total AUM of Solitaire? I thought. So total AUM of Solitaire will be closer to 1400 crores. Spread across close to 970, 980 clients. Uh, right. And in terms of CAGR over the next 3 to 5 years, I think the portfolio that we have constructed, right, over a period of last, I think from January till now, we have been slow in terms of deploying because opportunities have been scarce, right? So, but I think if it's been 1 year for you, we would have already deployed a lot of your capital, and portfolio will be well set to deliver over the next 3 to 4 years. But generally, as I was saying earlier, right, we are looking anywhere between inflation plus 7 to 9%, right? So anywhere between 14, 15%, right, is where we should be looking at over a longer term period. And I think Nifty itself over the last 30, 35 years has delivered around 11, 12% compounding, right? So something slightly over that is what we are trying to achieve. And I think that's what your portfolio can deliver over a 5 year period. Uh, some years may be flat, some years may be negative, right? But over a 4 to 5 year period, I think that is the kind of compounding we can expect from the portfolio. Because as Senthil was also saying, right, that we are looking to buy businesses which have compounding capability over a longer term period of 11, 12%, 13%, right? So that's the kind of businesses we are buying in the portfolio, where the IRR of those businesses over a 4 or 5 year period is 14, 15% or higher, right? So in that sense, that's where the CAGR may come. But obviously, market is very dynamic, right? And it may go through various cycles. So we need to stay invested, and the cycle is negative, or there is a lot of negative sentiment in the market or panic in the market. That's where you should come in and participate. Even smaller deployment around that time can significantly change the return trajectory of your portfolio. Yeah. Uh, so there's another question on tax disadvantage in PMS uh, compared to MF investments. Yes, I think this we have addressed it before also. Mutual fund investments, when mutual funds buys and sells, they don't pay tax. Only when you sell your long-term units, that's when you are taxed on the mutual funds. But in PMS, since the demat is in your name, so the taxation is applicable on individual securities buying and selling. But the focus is more on what are the requirements or what you are expecting out of a PMS portfolio over a longer term period. And if that is happening post fees and taxes, and it's in line with your risk appetite, and it's in line with your long term financial goals, I think then you can continue to stay invested. But obviously, mutual funds have an advantage in terms of taxation. And we have spoken a lot in our other videos on how we are trying to make it efficient in our PMS taxation, right? And that's a low churn strategy. That is something that we are buying. I'm not trading it into 6 months or a 1 year period. Generally, whatever we are buying is with a long term view of 3 to 5 years. There are many businesses in our portfolio that we have bought since inception and we have not sold yet, right? So in that way, buy and hold long-term low churn strategy is how you can fight out this disadvantage compared to a mutual fund in terms of taxation, and that's what the Solitaire is following since inception, right? I have been a Solitaire customer since last 1.5 years. I have following three observations. I don't see any banks in my portfolio. Why do you avoid banks as a sector in Solitaire? Defense. Did we don't we find anything interesting in renewable energy space? Because I don't find anything in my portfolio as well, right? Banking you will not see in your portfolio. Because Solitaire as a philosophy, as I was saying earlier, also we avoid buying into banking and NBFC businesses. Generally, we avoid buying any over leveraged businesses into the portfolio, and banking and NBFCs have a very heavy leveraged balance sheet. So you'll not see us buying them in the portfolio for now, right? And defense is again more to look at valuation. As I was saying, that we are not going and chasing hot sectors, right? We are focusing more on where the right value is available, and the returns or the portfolio or businesses earnings are sustainable over a 4 or 5 year period, right? Where this good fundamental and valuations are coming together, right? That's how we start building positions. And if we find something interesting, why not? But so far we have not like something that can fall into our comfort valuation zone to start buying. And that's why we have not ventured into that. On energy, I'll just request Senthil if he can share some insights of what we are thinking about that. Yeah.
Uh, I think similar to what defense Gaurav shared in terms of valuations. I think even here, because if you see within energy, uh, two things are happening. One is the traditional conventional fossil fuel based energy. There, that the globally the entire sector has been transitioning from here the conventional fossil fuel based towards renewables. So with this transition period, of course, I think the growth is going to be there, and then that's for that. But in terms of profitability and in terms of sustainability of the business model is where the question comes from, and also, and again, then the valuations thing. Uh, so because it's not just about growing the top line. So anybody can, in a emerging field, I think any company can grow at a very faster pace. But if you have to take cognizance of the balance sheet and the cash flow, because at the end of the day, when you are constructing a portfolio, I think the stability of the business is very much important, because uh, within a short policy change shouldn't affect the business. So from that angle only, I think even energy, but we have plays in the energy on the ancillary side. So like you mentioned, renewables, there is also a lot of energy transitioning to LNG and things like that. So we have a ancillary play on that within the portfolio. Yeah. And so Gaurav,
Okay.
that is one question on insurance also, like
Yeah.
uh, yeah.
I'll just take that. So see, I think it's a thoughtful question, right? And given almost a higher allocation on insurance sector in our portfolio, right? This question often comes up, right? And we talk about a sector which is highly regulated, right? So I'll try to just break it down and answer in very simple terms, right? So yes, insurance is a very tightly regulated business, but I don't think so that makes it a risky investment. In fact, in many ways, I think the regulatory framework actually reduces business risk by ensuring capital discipline, solvency requirements, and long-term stability of the business. Right. It's true that government rules can cap things like commissions, premiums, or even pricing flexibility for the companies, right? And that can affect near-term profitability or growth for some insurance companies. But these are short-term pressures. I think what we are looking at is long-term story, and that I think remains intact. So think about it in this way, right? Insurance penetration in India is very low, still very low, right? I think we are talking about a population of over a billion people, many of whom are underinsured or not insured at all. Right. So as income levels rise, right, awareness grows and financialization increases. I think more people are going to buy insurance, both life and health. So the structurally, I think the industry has a multi-decade growth runway. And what matters from an investment point of view is which companies you choose, right? So at Solitaire, when we look at insurance businesses, we are very selective. We are looking at product mix, persistency ratios, underwriting discipline, and obviously evaluations, right? And if this aligned, right, we have been open to buying them at those price points, right? So to put it simply, I think insurance is not inherently risky because of government restrictions. Like any other sector, right, it has its cycles and challenges, right? But I think the long-term opportunity is strong, and I think with careful deployment, it can continue to be a meaningful part of a quality portfolio, right? Um, so I hope that answers your question. There's one more question on for someone who started or entered just before 6 months. What is the advice to stay long, invest more, since the returns are relatively lower than the benchmark, right? So I think it's a very important question, and thank you for asking. Right, we completely understand why this is coming up. Uh, so let me say this, right? Every portfolio, right, no matter how carefully it is constructed, will go through phases of underperformance. And 6 months or 1 year is a really short period to actually look at performance, right? But this underperformance can happen to the best of the investors, right, including professionals and institutions, right? I think it's a part of the investment journey, but that doesn't mean that we are ignoring it or not looking at it. We review, reflect, and we are trying to stay true to our process of constructing the portfolio over a period of time, and then just waiting for it to perform. So in your case, I think performance might look slower in the recent past, right? In a short period of 6 months, right? Uh, I think the market in the last year has been very trend driven, right, and momentum focused. A lot of capital has moved into high risk, fast moving or thematic stocks, right? And we have consciously stayed away from those areas. Solitaire is a strategy built on bottom up investing, moderate risk, and long term quality, right? So that means we may not participate in every short term trend, right? And during such phases, we may underperform the broader indices or other flexi cap products, right? Our portfolio is positioned in less popular or currently out of favor businesses, right? Companies that the market is ignoring today, right? But we believe are undergoing structural improvements. And these are often the businesses that when they do come into favor, right, they deliver meaningful outperformance, right? But to benefit from that, we need time, patience, conviction, and continuous deployment, right, into those ideas as and when they are available at the reasonable or good valuations, right? In fact, if I can take you back to many of our successful investments, when we first bought them, right, most people only saw what was wrong in those businesses, right? Concerns around the business model, the promoter, or the sector itself, right? But what we looked for was how these concerns could evolve and improve over time. And right, that's exactly what has given us the edge in the past. We are not in the business of chasing what's hot. Our goal is to build a portfolio that can deliver sustainably over time, right? And that means staying away from short-lived fads, even if it means underperforming temporarily, right? Also, I think in times like this, it's very easy to get distracted, right? This constant noise, social media news, chatter about what's moving today, right? But I think the reality is most of these fast-moving stocks, right, eventually come down just as fast. And our job is to protect capital, avoid unnecessary churn, and stay focused. What we believe will create value over the next 3, 5, 7, 10 years, right? So that's where our focus is. Uh, one thing we will never do in Solitaire is compromise on the principles on which this portfolio is built, just to catch up with short-term performance. We won't take tactical bets just to show returns. Instead, when we do see underperformance, we focus even more deeply on our ideas. We research harder and position portfolio for the next leg of the cycle, right? So yes, your question about underperformance, yes, it might be uncomfortable, but it's not a signal that something is not right or something is broken. I think it's part of the process. It's part of the discipline that we are trying to follow. Uh, all meaningful outperformance begins in a phase where you are doing something. I think the market isn't paying attention to. I think that's where the real wealth creation will happen. And my request and suggestion will be that during such phases, if you consistently participate and add more, I think your returns over a period of 4 or 5 years will look different than someone who doesn't act during such times, right? So I hope that answers your question, right? There's another question on: do you provide any app for investor to track their portfolio of Solitaire? No, we don't have any app where they can track your portfolio as of now. The asset allocation, I think Senthil shared. If you can just go back to that slide of market cap allocation and sector composition, that we clearly show. I think we are close to 50-55% in small, and the rest is in mid and large cap with some small positions in cash. So there's another question on what is the strategy on this macro conditions for solitary returns such as dollar value troubled frequent tariff problem by US. So I think it's a good question and very relevant in today's environment. So at Solitaire, right, the way we are looking to handle global uncertainties like currency fluctuation or change in US tariff or even global leadership transitions, right, is by not trying to predict them, but I think by staying prepared through smarter portfolio construction. So let me explain how we are trying to do that, right? So as Senthil was saying, right, our focus is on India's domestic growth story. And hence majority of our portfolio is built around companies that earn most of their revenues from within India, right, and not from exports. And this shift we started doing early last year itself. So while we stay aware of global developments like dollar movement or tariff changes, the direct impact on many of our portfolio companies tends to be very limited. And we have consciously avoided sectors that are overly sensitive to global volatility, like we are not into highly leveraged export-led businesses or cyclical commodity stocks that swing heavily, right, with global policy moves, right. Instead, we focus on sticking to companies with strong fundamentals, having higher pricing power, and low dependence on external shocks, right. So, for example, if the dollar strengthens, right, or the US introduces new tariffs, right, export sectors like IT or certain pharma names may get impacted, right? But domestic themes like insurance, financial services, consumption, FMCG, right, or some manufacturing, right, that are tied to local demand, I think will remain relatively less impacted, right? Uh, and also, one thing to remember is that uncertainty like this, right, can sometimes create price dislocations and some share price dislocations, right? And that's when we get opportunities to enter quality businesses at better valuations or scale up existing positions. And we have used such moments in the past to strengthen the portfolio. So I think we are not unduly worried about this macro environment. Our focus in is that we are focusing on domestic, staying diversified, avoid leverage, and looking to act when others are nervous. And I think this approach is what is going to help us deliver steadily risk-adjusted returns, right? So I think that's where our focus is going to be right now, right? So the next question is on see the historical returns of Solitaire since inception more than 20%. Why are we skeptical about the return now? 50% is too low compared to what has been delivered so far. So I think it's great that you have looked at the historical returns. But yeah, Solitaire has delivered 22 and a half since inception, right? And we are proud of that. But we are not changing the way we have invested in the past. It's still the same, right? Our process is still the same. I think it's because responsible investing means managing expectations realistically based on current conditions, right? So when Solitaire was launched, right, valuations in the market were far more attractive, right? And we were able to enter several high quality businesses at reasonable prices, right? And from some of them were ignored by the market back then, right? Today, we are in a different market phase, right? Quality stocks, especially the kind we would like to own, are trading at fair to maybe slightly premium valuations, right? We are still finding good opportunities, but not available at deep discounts, right? And if in future we get such opportunities and our clients can participate, obviously the returns can be higher. And we have also just gone through a strong period for mid and small caps, right? And it's normal for returns to moderate a bit after such rallies. And that's why we guide conservatively around 14-15%, right? Which is, as I said, roughly 7-9% above inflation, right? It's not low. It's actually a strong risk-adjusted target in today's context. And as I was saying, right, Nifty over a long period has done something like 11-12%, right? Right. So just because we are guiding 14-15% doesn't mean we won't or we can't do more. We will obviously aim to continuously deliver and beat what we have done in the past. But promising a similar kind of returns that has happened in the past, right, is not right, right? And markets also don't move in straight lines, right? Our job is to deliver consistently risk-adjusted, sustainable returns, right, across market cycles, right? We remain confident, but also we are trying to set expectations realistically. And in the long run, this is the combination which is going to help investors stay committed and build real wealth. We are not focusing on taking higher risk to deliver that higher return. Our focus is more on the risk-adjusted return, and as Senthil was showing the data, right, and it's visible on your screen, right? Portfolio beta is 0.76, right? That means we are taking lesser risk to deliver returns over a longer term that will be higher than the benchmark, right? Uh, uh, how are you spotting the number one in industry? I'm investing. So we'll avoid discussing about specific stocks on the webinar. We can obviously get on a one-on-one call and have a discussion on that. Obviously, because of compliance issues, this is a public webinar. But on a one-on-one, we can discuss on that. How are you spotting the number one in industry? I will just request Senthil if he can throw some lights on how we are doing that.
So again, so it's not just we are just filtering the number one businesses and then we are just building a portfolio. So basically, so number one, even if you look at a let's say for example in automobile or auto component industry, uh, so the end result of analyzing the management, their past history, how they have scaled up the business. So these were the important. So if we see any business which has been listed for the last 10, 15 years, uh, so how the management has executed on a 3-year, 5-year, 10-year period, and then how they've scaled up their business. So obviously, if the management have executed well and then they have scaled up the business, obviously they have become number one in the industry. So this is where so the portfolio having market leaders is the end result, and so what our focus is and our where we focus in generating idea is on the uh, business quality, business model, and then the management. So even if the business is number 3 or number 4 now, I think if the management continue to execute, obviously over the next 3-5 year period, they have a fair or a high probability of them going to a number 1 position or number 2 position. So this is how we go about analyzing the stocks, and then now we research.
Sure. Thanks, Senthil. So there's one question on how are you how to find right and reasonable
Valuation.
valuations. Yeah. So I think that's what we are trying to do when we are doing long-term investing, right? We are trying to be very clear that a great business becomes a great investment only when you buy them at the right price, right? So even if a company has strong fundamentals, we have to wait patiently until the valuation offers a good risk reward, right? So for that, there's various filters and metrics that our research team follows, right? Uh, we take a holistic approach and looking at multiple data points, past performance, and how the businesses have moved, how the cash flows have been, how the return metrics have been, and how the peers in the industry have been doing, how's the earnings visibility, and how's the market sentiments and what events are playing out, right? So we are not rushing in into any business. Sometimes we track companies for months, even years, right, before buying, waiting for that window when the price aligns with our thesis and our comfort zone, right? So, in short, we find reasonable valuations only by doing deep research, staying patient and disciplined, and that's what has helped us buying quality businesses when the odds are in our favor, right? And that's how we have been looking to consistently identify and build positions, and we'll continue to do that. Obviously, different investors have different styles in terms of how they build positions and how and because this valuation can be very subjective, right, for different people, right? So we are trying to make sure that we don't overpay and stick to our internal matrix to bring such businesses into our stock universe, right? How are you spotting is done? I'm investing in how to allocate during market volatility as percentage of allocation. So I think that's a very important and practical question, right? Especially when markets are volatile and you are investing across different products, right? So I think we need to focus more on how we deploy during volatility, right? Volatility is not the time when you freeze. I think it's actually the time to act slightly aggressively. Let's say you have 100 rupees, right? So I think instead of investing all at once, maybe you can invest a certain portion right away and slowly maybe do an SIP and continue to deploy and build positions over a period of time. And obviously, when the markets fall or valuations becomes extremely favorable, we will definitely reach out to you to ask you to do some lump sum investments at that time, right? But otherwise, our view is that focus on think that volatility is not a risk. It's actually the entry point for long-term wealth creation. So keep contributing, keep participating, keep running your SIPs. SIP is a very good way to scale up your PMS portfolio or to use volatility in your favor, right? And being disciplined with your allocation. So Riddhi is more of a small cap portfolio which has a slightly longer time period. Obviously, 7 plus, and that portfolio will be slightly more volatile given the nature of businesses that we buy into that portfolio. So yeah, I think the next I entered the PMS journey 6 months ago and complete deployment of 50 lakh is done in the current volatility. What is the suggestion to top up with additional investment or wait for some more time to invest? So as I was saying, right, SIP is a good way to scale up your portfolio because anyways, it doesn't necessarily mean or we are not bound to deploy the money as soon as you add money to your portfolio. We will obviously wait and slowly scale up the positions if we get opportunities. Otherwise, we don't mind waiting. So SIP is a good way. And in addition to that, my team will be in touch with you in terms of whenever there's an extremely good opportunity and there's an opportunity to put in some lump sum into the portfolio. So at that time, you make sure you participate when we are reaching out to you, and don't layer one more uh, judgment whether you should participate or not at that moment, because we are coming with a very specific ask and requirement to deploy into the portfolio. But other than that, I think SIP is a very good way, and consider deploying at least when you have started the portfolio, right? For the first 3 years, consider deploying at least 25 to 30% each year to participate in every volatility, so that your portfolio is very well constructed over a 3-year period and set to deliver returns over a longer period. I have a suggestion for presentation slide. You presented a slide on how Solitaire is different from FlexiCap MF. In that slide, you should put the CAGR given by the different MF schemes for same time span. Sure, I think Senthil, we can do this, right? We can have the
Yes, yes.
returns also in.
Yeah, thanks, Vijay.
Thank you, thank you for that
mm,
suggestion. We can implement that.
clarity.
That's not a problem. If we don't have, then how do you know how much returns it has gave 3 months, 6 months? Do you send reports? Yeah, we share monthly reports with all our clients. It's sent to the registered email IDs, which has all the data. It's full transparent. What is the portfolio? What power returns it has done over 1, 3, 6 months since inception. It also has the cash, the transactions that has happened over that 1 month period. Everything is covered into that, right? So I think what value add you bring to your investor, how are you different from other PMS, right? I think it's something again that you need to decide how you would like to see, not just invest based on returns, because that sometimes doesn't end well. Uh, there are many options in the market, right? But what we are trying to do is follow a high conviction, low churn approach, and we are not trying to build a model portfolio. Your portfolio gets customized allocation over time. I think that is something that we are trying to do differently, and we are not trying to take unnecessary risk to chase outperformance. Focus is more on long-term contrarian mindset and strong partnership mindset, right? Which I was saying earlier, right? That we communicate openly, we encourage participation during drawdowns, right? And guide you through the cycle, right? Because you know that behavior as an investor is just as important as the businesses that we are buying into the portfolio. So if you are looking for a PMS that's built on clarity, conviction, discipline, and alignment, and not just performance chasing, right? I think if you're here to be a long-term investing partner, I think this product will suit you. But obviously, nothing in short term. Only over a period of 3 to 5 years, you'll be able to see the kind of differentiation that we bring to this whole process of managing money through the PMS cycle, right?
And
Being
Gaurav,
a
you want
customer.
to add a
Yeah.
point on deployment also, like how we add value on from the
Yeah,
deployment
correct.
perspective. Yeah.
Sure. So, as I was saying, right, that we don't follow a model portfolio approach. That is, the money you give in, let's say you bring in 100 rupees, right? We are not deploying 100 rupees on day one, right? As I was saying earlier, someone who started in January or February last year, we took almost 8 to 12 months to deploy that capital. So, our focus is very strong in terms of what we are paying for the businesses. Only when we find the right valuation, we are going to buy, right? So, in June last year, during central elections, markets got volatile, right? So that's when we increased our allocation, right? And then again, when FII started selling from October, November, December last year, our allocations to equity went up, right? So we are not just blindly deploying the money on day one. We are trying to be very cautious in terms of what we are paying for the business. And that's how the deployment is very gradual. And also, after the deployment is done, we are in constant touch with our investors in terms of when the opportunities are there, when new businesses can be bought in the portfolio, and they can participate in smaller tranches, maybe 2, 3, 4% of the portfolio, right? So that is something that we think not many PMS are doing. And that's where a lot of differentiation can be created over a longer period. I mean, you will not see the impact immediately of all these actions, but if you look at it over a 4 or 5 year period, and that's reflecting in our returns also, right? I think that's what you will experience if you stay invested for a slightly longer period. Being an existing customer in Solitaire, if I'm able to mobilize 50 lakhs to invest now, would you advise starting a new PMS with Riddhi or top the funds in Solitaire? So I think we can take this question offline and understand more about the expectations you have out of this 50 lakhs, whether it is meant for 2 years, 4 years, or 10 years, right? So based on that, we'll be able to discuss and decide how we should deploy or allocate this additional 50 lakhs into the portfolio. I think that's all.
Yes, I think. No more questions.
Sure. So we will reach out separately this additional deployment. How many switches, entry, exit purchases, and sales you do in Solitaire? I think our portfolio, as I've been saying earlier, is a low churn portfolio. We don't switch or exit positions in short term. We exit only when we have certain changes, structural changes, or fundamentally something has changed in the company. Some corporate actions they have taken that is not in line with what we expected from the company in terms of long-term growth. And maybe some corporate governance issue has propped up, or valuations have become extremely expensive, right? So without these three conditions being in place, we generally don't like to exit any businesses. We'll stay put into the businesses. And if you go and see our churn ratio in the past also, that will clearly reflect the kind of buy and hold strategy that I have been speaking about is also reflecting in your portfolio, right? So yeah, that's how we are trying to manage the low churn strategy in the portfolio, but not trading very aggressively, and just trying to hold on to the businesses that are comfortable for us to hold on. Will I be able to get the same tax benefits in mutual funds and PMS as an NRI from Singapore? I think this is not applicable for Singapore. It's applicable for, I think, some Middle East countries, but I can check on this and get back to you. Adding all this costs, what will be the overall TR we'll pay? That's why I asked because. So I think fees is 1.5%, and as a portfolio is a low churn portfolio, so the impact of taxation on the returns is also not going to be very high. But the fees plus GST and some custodian and fund accounting charges all put together, the fee might come closer to 2%. And on taxation, it depends. Like over a period of 4 to 5 years, there'll be a cycle there. Valuations become slightly heated, and then we will have to book some profits, which we have done in 2024. But that's not a every year phenomena that we are buying into momentum stocks or selling. Our focus is on buy and hold strategy. So we buy businesses for longer term. But obviously, when something becomes expensive, we do have to trim. So in those cases, there might be some tax impact. But otherwise, I think portfolio is a low churn and a long term strategy. What is the allocation among large, mid, and small? I think this already answered. It's 54% in small and rest is in large and mid.
Yes.
Yeah. Yes. Yeah.
And
sure.
Yeah.
Okay. Great. Okay. Okay. Thank you so much for your questions, and I hope we were able to answer. Some questions we would like to we'll reach out to you and discuss offline. And yeah, thank you. Thank you for your time. Thank you.
Yeah. Thanks, everyone. Yeah.
Thanks. Thanks.
Thank you.